Hey everybody, Mike Burkholder, Contra Costa. Today I have a very special guest with me. This is Rich Inglis of Paradigm Tax Consulting out of Brentwood, and he is a tax specialist who will hopefully provide some tips and tricks today of how to save you money. He is a very knowledgeable individual. He's a Rotarian. And Rich, how did you get into being a tax specialist, and what made you want to work with numbers your whole life? And then if you give people a quick bio on yourself, just to introduce you.
Well, thanks for having me, Mike. I got into taxes in 2007. Before that, I was in financial advising, and it just wasn't a right fit for me. I work well with numbers and strategies, and I found that the tax laws were a little bit more interesting and a little bit more of a challenge, and the ability to potentially come in and save somebody thousands of dollars on their taxes is something that drives me, and it's a passion of mine. I think people work hard for their money. They deserve to keep as much as they can and keep it out of the government's hands, where we know there's a lot of waste, fraud, and abuse.
Yeah, and in full disclosure, as we get into the interview, I do want to say that Rich is our tax guy for East County Today and our other side company, Mike and Mike Media. So just want to make that full disclosure known, and we'll jump right into this. So, Rich, thanks for coming in today and really just taking the time. I know it's crazy tax season, but let's just jump right into it. What are some of the things that, now that the W-2s, W-9s, and all that have been issued as of, or supposed to have been issued January 31st, what should people begin preparing for this year, and what are some things that people don't really think about?
So obviously the Tax Cut and Jobs Act was passed in 2018. It takes effect in 2018. It's the first major tax rewrite since 1986, so there's a lot of confusion around the law. For individuals, I would say the biggest thing to watch out for this year is when they change the tax tables, the tax rates that you pay, they redid the withholding schedule. And when they first came out with the W-4s, which is where you would indicate how much withholding you want, they released a mess of a form, and most people didn't know how to fill it out. And I think the danger is that people are not going to be withholding as much as they thought or they usually do, which could end up creating a tax bill at the end of the year.
And are you seeing that kind of prematurely this year, or?
I would hope by now that the word has gotten out, but that is definitely something I'll be advising my clients on when they come in if they get hit with an unexpected tax bill, is to let's take a look at the W-4, let's take a look at your withholding, and let's get things right for 2019.
And what would be the cause of that? Just people that don't mark the right box, or things they thought were write-offs maybe weren't, or?
It's more checking the right box or selecting the right number of exemptions. And again, when the IRS redid the W-4 form, they made it so confusing that even tax professionals couldn't figure it out. And so there was a lot of confusion around it, and people ended up selecting just the wrong amount of withholding.
So how would you say, like in 2019, how the rules have changed now that we're a year out? Kind of what are some of the unexpected things?
So in 2018, which is when this new tax bill started, and it runs until 2025, so the same rules for 18 will apply to 19. There are a few big ones, especially here in California, on if you itemize your deductions, meaning you have a mortgage, interest, property tax, charitable donations, the state and local tax deduction is limited to $10,000. So if your property taxes come out to $15,000, in previous years you would be able to deduct the entire $15,000. Now you're limited to $10,000. Some other big changes: the standard deduction it's almost doubled from $12,600 to $24,000. But they took away the personal exemption, which was a $4,600 deduction for each individual on the return. So for some people, it may help the larger standard deduction, but others with a large family, it can actually hurt.
So just to kind of hit that point again, and basically in Contra Costa County in the Bay Area, we're the ones that are probably going to get hurt the most with the mortgage tax deduction being limited to $10,000.
There's a very good possibility of that. Other people that are going to get hit hard, or those that are working in the Silicon Valley that may earn large incomes and pay a large amount of taxes to the state of California. I've seen some as high as $70,000, $80,000, which they would have been able to deduct before. Now they're going to be able to deduct $10,000 of that.
So our range in Contra Costa from anywhere from 400,000 to $1 million. We're not going to get punished like Silicon Valley.
Probably not as bad, although another change for 2018 is you used to be able to deduct up to $1 million in mortgage interest. That's been reduced to $750,000 for new purchases. If you already had your existing mortgage, that level stays the same. But again, people getting into homes nowadays, and that's Contra Costa is very expensive these days, that may be an issue.
So people previously, before the change, they're grandfathered in?
Yes.
Oh, good. Then I'm safe.
Right.
Minus the rhetoric of the Trump tax cuts and all the back and forth, has it really made it more difficult for you to do taxes? Is it easier? And I know that's a loaded question because everybody's different. What have you traditionally seen from the Trump tax cuts for just everyday people?
For W-2 employees that may own a home and not much else, the taxes are fairly straightforward. Not much has changed. The forms themselves have changed, but the process is is pretty much the same. Where it really gets complicated, and there's a few different areas. Number one, if we get into the mortgage interest of a loan over $750,000 or $1 million, then there's some calculations that need to be done to prorate the amount that's deductible. The biggest change is for business owners of pass-through entities, and that includes sole proprietors, LLCs, S-corps, partnerships. There is a new code section that never existed before. It's called 199A. And in simplified terms, it gives business owners a 20% deduction based on their qualified business income, and that deduction's taken off of taxable income. The problem is it gets very, very, very complicated for business owners because there's about 257 pages of regulations just around this Section 199A and how it applies to different business situations. And the other issue is the tax software has not caught up to these changes, and so everything right now needs to be double-checked by hand to make sure that the calculations are being done correctly.
So business owners could really be punished by just not, I guess, and I don't want to say for the software not being there or not using an expert, but it's really just that complex.
It really is. And I wouldn't say the business owners would be punished. It's more the tax professional that's doing the return that has to verify the calculations. But for business owners, as long as you fall within the parameters of the Section 199A deduction, it's a very, very good thing.
So really then business owners just need to make sure that they're in the right formation outside of a sole proprietorship and get into corporations, whatever version they want, partnerships, kind of get out of that whole sole proprietorship then.
Really depends on the income level and looking what they're looking to achieve. Sole proprietors do get to take the Section 199A deduction.
But but for the bigger cuts and bigger benefits, it's kind of changed it a little bit.
Potentially, and that's kind of where the tax planning comes in. It's looking at all the different entities and running scenarios to see where the biggest tax savings are going to come from. Because it's not a one-size-fits-all. I can't say that everybody should be in a corporation. Sure. It would be looking at the individual and making that determination.
And then those are the kind of services that you could do. Someone could come in, meet with you, run the scenario, and then you could make a recommendation based on prior tax years and assumptions going forward?
Absolutely. And we can show them the tax savings that would be involved with each particular entity and, again, decide on the best course of action.
And so I want to kind of move forward into 2019 and, as people prepare for their taxes and going forward past this year. And I know that this is a very general advice question, but what are some examples of where people should adjust their withholdings so that they don't see a tax burden going forward? Is there kind of a a standard example that you like to give of, maybe withhold one, now it's withhold two, or kind of go, or maybe go to zero?
There is no hard and fast rule there. It's one of those things where make sure that if you are having your taxes done by a professional, that you ask that question of your preparer and make sure you get an answer. They should be able to tell you generally based on 2018 taxes where you need to make adjustments on the withholding. But other than that, that would be the best advice. There's also withholding calculators out there. I believe there's one on the IRS website where you can go in and plug in your income, your tax bracket, and it'll tell you, it'll make a recommendation as to what you should choose.
For those that like to deduct their mileage, you like to use a certain tool that you try to get me to use. Can you explain how that's beneficial just to use kind of those apps out there?
So for business owners, mileage is a lot of times one of their largest deductions. And the IRS requires that to take that deduction, you have to keep a mileage log. And it used to be in the past where you would have to carry some sort of a notebook or a binder, and every time you went somewhere, you would write down where you went, how many miles you drove, and then you'd have to total it up at the end of the year. If you forgot to do it, you would typically have to go back into Google, map it out. So I use a tool personally called Mile IQ. It runs on both Android and iPhone, iOS, and it uses the phone's GPS to track your trips. So every time you jump in the car, Mile IQ will track that trip that you're taking, and once it finishes logging, you have the option to either select personal, which would be something like a commute or weekend travel, whatever, and discard that, or slide it over to business. And at the end of the year, so it'll total up your business miles as you go along, and at the end of the year you can print out a report that is bulletproof and is perfectly fine for IRS audits.
And so do they really actually check mileage logs, and how do they check that?
They actually do. I've been in several audits for business owners, realtors specifically, and what they will do is I actually had one realtor who didn't keep a log but had a list of every one of their listings, every one of their rentals, every one of their appointments. So we used a combination of listings and their calendar to show that the mileage taken was in fact legit and the IRS allowed it.
And then what about, have you had a scenario where they actually get penalized for not keeping a good log?
I have come close. I've had to.
You personally.
No, not me personally. This is another audit. Again, they didn't keep a mileage log, but they had a very detailed calendar, and that was it. But we were able to show a consistent pattern with earnings and the nature of the business that they were in. It was a multi-level marketing, so they're driving all over the place. So I was able to argue that look at the income, look at the miles, look at the calendar, and we were able to get the miles approved.
Now, in your business, does retirement planning come in at all, and does that impact taxes, and how could it, I guess?
Retirement planning does to some extent. It's part of the tax planning process, especially for business owners. The recommendations I would look at as far as tax deductions, do you want to be just a regular traditional IRA? Does it make sense to start a 401k for those that are making more money and have larger companies as a defined benefit plan? But these are more tax saving strategies rather than necessarily a full-blown retirement planning scenario. There I would refer them out to a financial advisor.
Now you're kind of like in the news a little bit, where you provide people the opportunity to realize good news, which is they get their refund and they get money back. But then you're also kind of, some scenarios provide bad news because people will have to owe money. So your whole job is to essentially keep people from being audited. I would say that's kind of the goal, right? So why should people get in a tax person?
So yeah, I'll talk about the first part first. Is yes, it is very nice to come in and give somebody some good news, saying, hey, you're getting a lot of money back. On the flip side, it's never fun to give bad news. Usually the bad news happens if somebody has done something throughout the year without consulting me so that I get surprised at the end of the year, or it's a new client who hasn't worked with me before and I'm just learning their tax situation. So hopefully, as people work with me as the years go on, we don't get those surprises. I try and train them that if you are going to make a large financial decision, let me know first so I can let you know about any potential tax implications. As far as why should somebody work with a tax professional, there have been, in the last few years, a couple of occasions where I had new clients come in. And one of the things I do is I will always review the tax returns of the previous couple years. And in one case, this is a person that had been doing their taxes for years on TurboTax, but ended up with some stock options and didn't know how to handle them. So they came in to have me handle the stock options. Well, they also had a couple of rental properties. And in reviewing the return, I discovered that they had been doing the rental properties incorrectly in TurboTax. And I was able to go back and amend 2 years of tax returns, and I got them back over $10,000. And part of the reason they didn't want to come to an accountant in the first place is because they thought it was going to be too expensive. Well, I can pretty much guarantee you that those years of doing tax returns would not have cost $10,000. Now, the unfortunate part is when you amend returns, you can only go back 2 years. That means in years 3, 4, 5 in the past, I could not do anything with those tax returns. And so they left quite a bit of money on the table. And that's actually, it was another scenario, but I literally had a couple clients come in for the first time and found mistakes on previous year's returns that have resulted in tens of thousands of dollars of refunds that if they had not come in, they would not have seen.
So it's kind of one of those things where you pay a little bit up front, but you could get a lot more back. I mean, in every scenario is different, obviously, but you're kind of that double checking, verifying, making sure they're within the laws, and could save them actually a lot of money and penalties later.
Correct. The other issue, and I've seen, is in some cases the mistakes end up costing them money, but they would have been caught anyway. The biggest challenge when, especially if you're a business owner, get into more of the complex situations where you've got stocks, you've got rental properties, is it's what I always like to say with TurboTax is it's garbage in, garbage out. TurboTax will prompt you and you can put the numbers in, but unless you know the tax laws and where the numbers are supposed to flow on the various forms, you're not going to know if those numbers are right. I would suggest if you're in a more complex situation, unless you really know the tax laws, that's where it helps having a professional do the taxes. And that's what happened with my client that I was able to get the $10,000 back. They didn't know how things were supposed to flow, and they ended up hurting themselves.
And so in closing, what's kind of your 3 tips for 2019 and for those filing taxes right now?
We've already covered one of them, but I would say if you come in to get your taxes done and find out you're not getting as much money back as you think you were going to based on previous years, that's where we would come in and take a look at your withholding. Ultimately, it's not about the well, it is, but when we talk about refunds versus owing, really what we're doing is we're looking at the total. Your refund is your total tax minus your withholding. And so it's just making sure that that is where you want it to be. So again, you're not going to get surprised. Second tip, again, if you're a business owner, don't wait until December 31st to all of a sudden realize that maybe you need to do some tax planning. Tax planning and where I work with my clients it's a year-round process. It's not something you just decide to do at the end of the year. So it's staying on top, collaborating with your tax professional on a monthly basis, quarterly basis, however that's set up. But that's critical, especially if you're a business owner. And I would say the third one again is just when we're talking refunds versus owing, it's not about how much money you get back. It's really about the total tax that you owe. With these new tax cuts, a majority of the people are going to see lower a total lower tax bill, but that could be skewed by the withholding. So really what you want to do is you look at your 2017 tax versus your 2018 tax to determine how beneficial these tax cuts were to you, rather than looking at your refund, because that's not really helpful.
Sure. And so what I like about you is you've kind of revamped how you've done your business, and I'd feel kind of guilty if I didn't ask you to plug your new services and kind of your new strategy to helping both, business owners and just everyday Joe. I mean, can you kind of share with people what you're doing?
Sure. So this past summer, I received a certification, Certified Tax Coach. It is the certification that recognizes advanced tax planning. And it covers a little bit what we just talked about on that tip of 2019. It's really sitting down with somebody, looking at their tax situation, and coming up with advanced strategies to save the business owner or the high net worth individual a lot on taxes. I just sat down with somebody yesterday that is a sole proprietor and ran some calculations, and based on the strategies I'm recommending, I can save them $40,000 a year in taxes on an ongoing basis. So I'm not going to say that's going to be the truth for everyone, but those are the things that we're looking for. And without the certification, without that person coming in and seeing what's possible, they would have kept doing things the same way, leaving a ton of money on the table. So that's really the direction that I'm taking, and there's not a lot of other tax professionals that are out there doing that. Most of them have the client come in, they'll do the return, say, oh, you might want to throw $5,000 into an IRA, and that's pretty much it until next year. So my goal is to be engaged with my clients on a quarterly basis, understand their numbers, look at strategies that may be able to be deployed to save them taxes, and again, assure that there's no surprises at the end of the year.
And you're located in downtown Brentwood?
I am located in downtown Brentwood. I'm at 613 First Street, Suite 210, and I'm right above Zephyr's Restaurant. I'll give them a little plug.
Which is very good, by the way. And actually, there's a lot of good downtown Brentwood restaurants. So go down and eat and have Rich do your taxes while you're waiting.
Or if you get some bad news, go to the bar. And
what would be your drink of choice?
Jameson's and soda.
See? There you go. It's a tax guy's drink. Well, Rich, I want to thank you so much for coming in, sharing your expertise, sharing some drinking knowledge too. That's always a plus. But again, I wish you luck in this very busy time of year for you. I know you'll probably be in the books, in the computers for the next 2, 3, 4 months. So I'll see you on the golf course in June, July. And so everyone, thank you so much for listening. Again, Mike Burkholder, Contra Costa Today. Please like, subscribe, follow, and we'll see you next time. Take care.